presentation which has already been uploaded. We're on page 5. Like we mentioned, our general merchandise and apparel contribution has been lower than the past trends. So while food and non-food FMCG are more or less trending on similar lines, there has been a higher impact on the downward side on the general merchandise and apparel sales contribution, and consequently that's why our gross margins have reduced in the recent past. Our cluster-based expansion strategy continues. We've constantly focused on this lever of operating leverage, which comes by having more and more stores in the same region, and that continues. We added 40 stores in this period, and it's the same, more of the same. Page 7, DMart Ready. This is our e-commerce business model, which is housed under Avenue E-Commerce Limited. We added 10 cities, but these are the additional store city locations have not added to that extent incremental revenues, because the structure or format in which we operate are more like a pilot, and hence we are still more of a work in progress approach to the new city operations. We continue to believe that grocery e-commerce has tremendous opportunity in very large towns and densely populated or vertically densely populated towns, and we continue to have that belief. And hence, to that extent, our focus will be more dominant on the large towns of the country. Page 8, again, it shows the trend line of number of stores that we opened. Financial year 22 shows 50 stores because that was more of an overlap of delayed openings of 21. 23 we opened 40 stores. I've spoken a lot on our real estate strategy and the reasons why we cannot accurately predict how many stores we will open in a year. But our intent and objective is obviously to maintain a run rate of the past. So that's a broad point of view there. Then we go to operating and financial summary performance. Again, the formats, the structure all remains the same. Total bill cuts have moved from 18.1 crores to 25.8. Like-for-like growth, we do like-for-like for 2 years and older stores. That's been 24.2%. But I think the more critical point to note is, which I've mentioned in my comments for in the quarter ending Q4, where I had said the like-for-like for 6 months was, I think, 11%. Yeah. So that's the more comparable number that has least COVID impact, and it's a more comparable number where like-for-like was 11% for second half of last financial year vis-a-vis the year prior to that. Again, we added 1.9 million square feet, and revenue from sales obviously per square feet is at 31,000. This is primarily because the store sizes are larger. We are quite satisfied with the recovery, except for I'm sure there will be a lot of questions on general merchandise and apparel contribution. But other than that, I think we're pretty confident of the business. All COVID-related issues are behind the back. We're very bullish on the brick and mortar business, and we continue to focus in this area. We believe that there's huge opportunity, to do better and better in the brick and mortar business. Yeah. So 31,000 revenue per square feet is more a factor of larger stores being opened in the recent past. Otherwise, from an ROI perspective, overall performance perspective, I think we are placed pretty well. Page 11 again is the same, more of the same. We've done 41,800 crores of revenue. EBITDA is 8.7%, PAT of 6.1%, and net cash flows of 3,113 crores. I think it's quite stable, and we're quite pleased with what we have done. Again, page 12, days inventory. That's an interesting data point. It's come down from 36.5, then 33.3 days to 28.8. But this is, I think I'd like to spend a little bit more time there. I think that's the beauty about a model. Our ability to be agile and flexible, it's automatic, right? So if general merchandise and apparel, which tend to have more inventory, if that's not doing too well, the inventory by itself also gets corrected, and because the contribution of food FMCG and non-food FMCG increases, and hence the mix of inventory also changes. So that's why the number of days have come down. And on fixed asset and inventory turnover ratio, again, we are slowly inching back to our pre-COVID numbers. In fact, it's getting better with time. And obviously, return on net worth and return on capital, these are all self-explanatory numbers. But I think we are the trend lines everywhere is coming back beautifully to the pre-COVID levels, and we are quite happy with how we are trending on that front. I will jump to not page 13 but page 14, which is a more interesting slide. Page 13, I mean, it's all self-explanatory, but I'd like to spend some time on the e-commerce business. What is interesting here is that our view is that all the worries that we had about how much money we're going to lose and how this business is going to trend is actually 90% gone. We're quite confident with our ability to run the e-commerce business, and we feel that it's not an either or. The e-commerce business or DMart Ready business can draw out its own path and build the business on its own, having the tech mindset and approaching the market from that standpoint point of view. And probably another 2 to 3 years will tell us, what will be the cost sides and the margin side impacts on the business. The one thing I feel about grocery is the grocery business, if run well on the e-commerce side, cannot lose too much of money, unlike the marketplace. And I think that's a huge positive for us. I mean, all the anxiety that we had about how much money this could lose has actually gone. We know now that it can't lose too much of money. How much money will it make? I mean, that we cannot comment. Broadly, I can say it will be driven by what are the gross margins we will make in this business, which is quite challenging. But the cost of operating the e-commerce business will be little more, or probably relatively more. I'll not say little more, relatively more than running a brick and mortar business. The fact that the order is being picked for the customer and being delivered to the customer at a more convenient location, either at her home or closer to her home, is going to cost more than running a brick and mortar business. That's the broad view that we have. Yeah. So from that standpoint, I thought I should comment on the e-commerce business. The food plaza business is basically all the food services. We see a opportunity there. So the food plaza business helps in making the brick and mortar business more stronger. And similarly, the L&D retail business, which is again a subsidiary which manages all the staples business. We also believe that that's another area that has immense potential and opportunity to make the brick and mortar business stronger and stronger. And then we've also started up a pharmacy business, which again, the whole principle is it complements well with the brick and mortar business. And hence, we're also paying attention to that side of the business. So with that, thank you for listening and open for questions, please.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, Neville. Thanks for the opportunity. I wanted to, first start with the general merchandise and apparel segment. Now, in this quarter, you had highlighted specifically that general merchandise has recovered, but it seems that apparel is yet to bounce back. The question that I had is, would you believe that online players like Myntra or offline players like Zudio are able to wean customers from our apparel offering, and what are we doing? Is that a concern for you? Or if you could kind of just spend some time to help us understand what is missing or what is hurting the growth in this business segment. Thank you.
Thanks, Avi. So I would say it in two ways. So let's look at it this way: external and what's internal. I think externally we all know what's going on. I think the whole country has suddenly figured out that this is a space that has a huge opportunity, and you have a lot of players who are trying to get into this space. This typical $1,000 and below price point, more focused around 500, 600 rupee price points. And obviously earlier that segment you had fewer players. So obviously that's one area definitely. Okay, there's a lot of activity happening there, and people are getting more choices. And when they have more choices, obviously it has an impact for us. We're also seeing, and that's another compliment for our model, is that because we drive so much of traffic, I think there is a clear mandate, is what we see, that a lot of these formats open very close to where a DMart store is. So that's the second thing, which are both external, which is happening. And internally, I think probably apparel may not be the best aligned category compared to say a staples or a general merchandise. I think from an aspiration standpoint, for a supermarket or a value retail grocery retailer, apparel may not be seen or perceived to be that aspirational compared to a general merchandise or buying food or all of that. And that's an accepted norm. If you do any psychology, consumer psyche testing on all these aspects, that clearly comes out. So now considering what's happening and the market is getting more efficient, what is it that we need to do internally? And that's where my question is. I think we need to do a lot of more work internally. I think from an internal structure standpoint, people standpoint, on the apparel category management standpoint, I think there has been some misses, some opportunity misses, or the quality of thinking that is needed on what we should do has got a bit lost, and I think we need to work really hard there. And our view is that we have to make we can't be what somebody else is trying to be. Okay, so we are very clear that we are a first grocery format. Okay, and within that, how do we position apparel? I can't be a lifestyle discounted retailer of apparel, a specialty value retailer. I can't be that. I am a grocer first. So within that space, what is it? What is the opportunity I have? I think there is still a huge opportunity to address in the basic segment. Okay, and we are working on it, but we are approaching it from a perspective about anything that's very low on high fashion, but very, very basic, great value, immense value, applying the principles of DMart. Okay, so like I always say that if you want to wear a t-shirt to be worn at home, or you want to wear nightwear which you wear at home, or you want to go to a local bazaar to do some shopping, you need some apparel or footwear, you come to DMart. But if you want to go to a 5-star hotel or you want to go to a expensive party, DMart is not the destination to buy apparel. We're very, very clear about that. I think somewhere there we have to be more precise, and we have to fine-tune our assortment more effectively from that standpoint. And I think with that, we should be fine. Yeah. And I think also our conversation should not be binary, that is general merchandise and apparel. I mean, apparel should not be the issue. I think the ecosystem around non-FMCG and what are the other saliences that we can have by adding more and more horizontally into the format is something we should think about. That's the longer term opportunity, and that's why, if you remember, I've been saying that the opportunity of having larger stores, it allows you to experiment. Yeah. So it's not just about apparel not doing bad. In the longer term, quite likely apparel will continue to have a lesser contribution to our business, and that's okay. Yeah.
Okay. So I mean,
I've been able to answer the question.
So if I just, as a simple follow-up, just to, in terms of the general and merchandise and apparel total sales, would it be fair to say apparel is a relatively small component of it, or a major, equal component? Any idea? I'm not, just to kind of understand the extent of how much this track can be, at least from a near-term perspective. Because I hear you that there is a portfolio work that you are essentially doing to better address that art opportunity. But if you could give us some understanding of the extent of this salience, or thank you.
I cannot comment on that, Avi. All I can say is that between the two, apparel is a lesser of a contribution. That much I can tell you. Yeah.
Okay, perfect. That's all. So the second bit, if I may, on the you had highlighted in the last meet that quick commerce is not a concern for us from a brick and mortar. A, if that thought continues, and B, are you thinking of exploring that space through DMart Ready? Because there is a clear consumer need, and I remember your earlier comments that you said we will go where the consumer is. So just wanted to understand this better.
Yeah, I think we're in a very sweet spot, Avi, from an e-commerce perspective. The way we are doing a brick and mortar business is also what we are looking at in terms of ensuring that the customers buy more and more. So our focus is on increased basket values, and our focus on customers continuing. Every time he or she buys on Ready, her basket value has to be large enough. Yeah. So I think when we are focusing so much on that, going the quick commerce way, so let's put it this way: instead of ordering twice a month, if she starts buying 6 times a month or 7 times a month, but the basket values are sizable, happy to service her. Now, if you call that quick commerce, fine, let's call that quick commerce. But we all know what real quick commerce is, right? It's a lot of impulse, it's a lot of low ticket value, it's all about delivering the next 30 minutes. I don't think we are focusing on that space. We are focusing on bulk, but we see an opportunity in delivering earlier. Yeah. So earlier we used to deliver on an average maybe 50% of the orders in 24 hours. Now we are saying 100% should be in 24 hours. Then within that we are saying, okay, how much of this can be delivered in 12 hours? I think delivering in 12 hours is a good vision to have, considering the size of the order we have and considering the assortment of the order. See, when a customer on DMart Ready shopping, she's not expecting the order in 30 minutes. She's not expecting 60 minutes, right? Because the heavy stuff, buying a lot of groceries, it's like her monthly shopping. She gets great value. And she also uses other apps to get her, stuff quickly, right? But we'll focus on the bulk as of now, Avi. Yeah?
Okay. And sir, if you may allow just the last bit, any change in discounting from peers, anything that we should, if you're seeing reckless discounting kind of emerge, or from the other offline or online peers? That's all from my side. Thank you.
That continues. Our margin is a reflection of what is the benchmarking that is operating in the market. And I think nothing much has changed like for like from last year to this year. So I think it remains the same.
Okay, sir. Thanks a lot for answering these questions. Thank you very much, sir.
Thanks, sir.
Thank you. The next question is from the line of Garima from Kotak. Please go ahead.
Hi. Thank you so much for the opportunity. Neville, first question again on general merchandise. At some level, do you think it is unfair for us to assume that the contribution of general merchandise to your overall revenue mix can actually go back to pre-COVID levels, or should this just find a new intermediate normal?
Yeah, it's a good question, Garima. So when I look at our very, very old stores across the country, when they started, and I'm responding to this question even in earlier analyst meet, but I will say this again. So whenever these businesses start, whenever these locations start, the non-FMCG contribution, that is the general merchandise apparel contribution, are higher. And as they mature, the contributions of general merchandise apparel reduce. Okay, it has been a secular trend for the last 20 years. And why does that happen? That happens because when you open a store in an area which is fresh, new, first time DMart, you tend to get a lot of people from a larger radius. Okay, and then they happen to be there, they buy groceries, but they also buy a lot of general merchandise and apparel. Over a period of time, what happens, people who are more and more closer to the store, their shopping becomes more intense. Their frequency is more intense. So more frequency and more the shopping intensity, automatically they're not going to buy the same percentage or the same contribution of general merchandise apparel. They tend to buy more and more of groceries. So as my revenue keeps growing at a healthy CAGR every year, there is a higher revenue share of FMCG than of non-FMCG. Yeah. So from that perspective, yes. But if you ask me today, as of this year, from a general merchandise apparel, should I take that view and say, oh, nothing, there is no issue? Not really. We do have an issue in apparel specifically. Yeah. I also commented in my Q1 comment that GM was probably, general merchandise was more of a COVID and a lot of other things, and we've got it back, more or less. Yeah, I mean it is coming back, but apparel is an issue for the question, for the comments I made just recently, and we have to work on it. Yeah.
Understood. Second question, can you talk a little bit about the cohort of new large size stores, particularly stores that have opened in relatively new areas such as parts of NCR, Punjab, etc. And are these stores from a throughput and store economics perspective behaving generally similar to your older stores in geographies that you've understood very, very well?
Okay, so both Punjab and NCR are quite delighted. Store economics are trending similar to how we used to trend in other regions when we started around for the same, tenures. So we aren't having any issues there. We are quite happy with the outcomes. So no issues in NCR or Punjab.
Understood. And third question, quickly on e-commerce. So could you highlight the performance of this business within Mumbai, because this is your sort of longest performing geography, and how much of your revenue is being contributed by Mumbai, and in terms of profitability targets, do you expect this business to break even in Mumbai anytime soon?
So that depends on how you define break even. Yeah, different people have different views on break-even. For us, break-even is at the PAT level, considering head office cost, everything, right? So from that standpoint, I can only comment one thing, Garima, that MMR region is better than the overall company.
Overall company meaning Avenue e-commerce?
Yeah, Avenue e-commerce. I think Avenue e-commerce is a loss of negative 9% on revenue, right?
Right.
9 point something. 8.7. Yeah. 8.79, yeah. So Mumbai obviously is better than this. That is all that I can comment.
But the majority of the revenues would still be Mumbai. Is that fair to assume? Although you have added, a large number of cities in, say, the last 12, 15 months.
Yes. Majority of revenue is from Mumbai, but the operating losses in the newer regions are significantly higher, right? Because when you start up, so yeah.
All right. Understood. Thanks so much, Neville.
Thank you. The next question is from the line of Arnav Mitra from Goldman Sachs. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question was on the relatively lower salience of GM and apparel. So, Neville, my question was, does this in any way affect your ability to offer lower prices in grocery while maintaining your gross margins? Or are there other offsets like potentially higher scale giving you better margins from your suppliers, which will allow you to maintain your gap with competition on pricing despite having lesser salience of the high margin categories?
So answer is it has no bearing on our ability to compete. Yeah, and that is why the gross margins have come down, right? There has been no attempt internally. My contributions are lower here, so I'm making lesser margin, so I will raise prices, or I'll hold prices. I will not compete. Absolutely not. And that's why gross margins have come down. And the business, I mean, you see the numbers, right? With the PAT we have, there's no worry. I mean, from a competing standpoint, there is nothing to bother about. It's just that PATs will go down. PAT as a percentage to revenue will go down. So what? But we'll compete.
Got it. Understood. And Neville, second question was, if I look at your overall bills cut, this is one number which, before COVID used to grow at 20-25% every year. That seems to have, on a 3-year CAGR basis, grown at more like 8-9% in the last 3 years, pre-post-COVID. Anything that you read into this? Are there less customers? Because your store space addition has been similar. Is the pace of new customer acquisition, even in grocery, reduced, or how would you read this data point?
The only broad point we look at, Arnab, is that over the last 2 to 3 years, we've opened a lot of stores in smaller towns. Okay, and like I've always mentioned, smaller the town, lesser the cost of real estate, less, but overall investment lesser, but revenue become higher. Even the revenue is low, so number of bills are lower, walk-ins are lower. So it is that mix. It is a mix that of new store additions that is making you look at the numbers that way. I mean, which is a fact, but it's primarily because let me put it this way. I think 5 lakhs and above towns. We used to have 68% of stores, say 3 years back. It's come down to around 60% now. So 40% of our stores, are below. So broadly, we have opened more stores in smaller towns. That's why the numbers look like that.
Understood. And my last question, Neville, was on store opening. As you mentioned, you probably want to maintain the run rate 40 stores a year. Given the opportunity size, I think you last time mentioned more than 1,000 stores potential that you see. Is there any internal way you could accelerate this addition because your base of stores is higher? So as a percentage of base, the addition is actually slowing down if you do not increase the number of stores.
Yeah. The one single point mandate is store addition. I think from a model business, everything is fine. It's just store addition. That's a single point agenda.
So my question was 40 per store a year is not a constraint in terms of your internal bandwidth of adding stores.
Not really. You have to work harder is all I can say. But yes, it's a huge opportunity, and we have to accelerate our ability to acquire more stores. See, it is a huge effort. I mean, 40 stores every year, the amount of work that goes by, but we have to do it. We have to. I mean, very simple. That's the single point agenda now for us. All other levers are ready to fire. Our ability to run the stores, our internal processes, systems, tech, everything is ready. It's all primed. We just need to open more stores.
Okay. Thanks so much. That's it from my side.
Yeah.
Thank you. We have the next question from the line of Sheila Rathi from Morgan Stanley. Please go ahead.
Yeah. Good morning, everyone, and thanks for taking my question. Just extending to the previous participant's question is with respect to stores. So, Neville, the first question is availability of good land parcels a bigger concern, or availability of employees a bigger challenge for us?
Obviously, land is a bigger issue. Because land is a bigger issue, then you have to have a solid team to get those properties. But when land itself becomes an issue, then it has an exponential effect. You have everybody's chasing the same resource, right? Who has great expertise on this, and hence having a large number of people who has that expertise and to convert or close deals is a challenge. Okay, and hence, but we're working on it. I mean, yeah, but land is an issue. It's not easy. That's why very few retailers do this, right, in India.
Sorry, could you repeat that?
That's why very few retailers do this, right? Acquiring land or building stores. I mean, generally, the reason why a lot of retailers go to the lease model is because this is a difficult area to handle.
Yeah, but from a near-term perspective, are we seeing challenges with respect to getting more people in our workforce? And we have always maintained a 20% to 80% ratio with respect to contractual versus permanent employees. Are we looking to change that?
The structure of the model remains the same in all elements of the business.
Understood. My second question again is on the GMA bit. So you said that we are grocery first. So if we believe that the focus on GMA could be modified and could be different from the past, are we willing to say that the gross margin profile for the business could be different and could be instead of 15% could be 13-14%? Is there something which worries us, or we are thinking about that in some way?
I can't comment on that. All I'm saying is whether it is 16% or whether it is 12% or 13%, the business is resilient, the business is adaptable, agile, and see, key point is being relevant to the customer with the positioning of value, right? We shouldn't disturb that. I mean, how a consumer or a shopper thinks about DMart, that shouldn't get disturbed at any cost. So for us, our view is we think from that standpoint, and within that, then whatever is the outcome is the outcome. Yeah. So our direction to the team is this, at the operating side and the merchandising side. This should never be disturbed. And then the operating side operates the business efficiently. The merchandising team then figures out what should be sold and at what cost and at what margin. Yeah, I mean what price and what margin. That's it.
Understood. And my final question was with respect to DMart Ready. I think Neville, you sounded much more positive with respect to the e-commerce business this time versus the past. So what has changed? I am one of the consumers who get that 12-hour delivery. So I'm very happy about that. But is scaling helping us to be more confident that we can be profitable at some point of time, or is there some strategic change which we have done that is helping us to feel more confident?
I was just joking with my team today morning that for all the tech that we talk about in the e-commerce business, at least for grocery, actually it is more manual labor involved than a brick and mortar business. Because the effort involved in picking the material and delivering it to the home, actually that cost element and that people management is a significantly larger effort actually, okay, compared to the brick and mortar business. And secondly, I think even from a SOP and a process orientation, people think that brick and mortar business has more. In fact, that's completely wrong. The e-commerce business, especially on the brick and mortar, on the grocery side, the level of precision that you need from a standard operating procedure is at a different level. Because somebody has ordered something 12 hours or 24 hours back at a particular time slot and they want it, I mean, the lag between ordering and actual delivery is like 12 hours or 14 hours. Okay, it's not immediate. When you shop in a store, you're picking the stuff you're getting billed, right? You're billed exactly for what you've picked, which is quite. I mean, if you make a small mistake, that there could be one item short or two items short in practically every single order, right? So I think from a sheer operating principle standpoint, the e-commerce business is actually significantly more complicated on the operating side and the people side than the brick and mortar business. And obviously, that was also one of the thoughts we had, that if this has to be done really well, then we should be able to do it, because we are supposed to be good in process optimization, efficiency, all of that. And I think from that standpoint, why we are more confident today that we can run this business. Okay, we're using the same principles as which we run the brick and mortar business. Yeah. And secondly is the tech side of the business. I think we have a marvelous team, fantastic. They've done a brilliant job. So they are also, I mean, they complement, and they are the forefront of this business, because how they imagine and how they think about running it is very different from how we think, and hence keeping this business separate has helped us a lot. Yeah. So it's a complement. It's a win-win of both sides. So that's why we're more confident. And from a financial standpoint, we're more confident that we won't lose too much money. Yeah. So that's why the confidence.
Thank you. Thank you very much, Nitin.
Thank you. The next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hi. Thanks for the opportunity. Let me continue with a bit on the e-commerce. I just wanted to understand, you are currently in about 22 cities. Would you look to expand to more cities, or you will want to, scale up operations in new cities first? And as far as the revenue share is concerned, on a consolidated basis, though it's a single-digit share, but for Mumbai, is e-commerce or DMart Ready now and has a double-digit revenue share? And does it in any way starting to influence your physical store expansion plans?
So, okay, if I got all your questions right, choice between having more stores in the same city versus.
The first is, will e-commerce continue to expand more, or will you consolidate first?
Yeah.
Latika, that's right? You want to understand if we were going to expand
into more cities, or you are happy to first scale up in existing cities,
I think we would now take a pause and focus on these cities and try to scale up within the existing cities rather than move into other cities on the e-commerce side. And as far as cities like Mumbai is concerned, that's a very interesting point, and I think that's also something very fascinating. In spite of a decent contribution coming in from e-commerce in Mumbai, our Mumbai stores are also doing well. I mean, they haven't declined. We haven't got revenue incremental on e-commerce at the cost of the brick and mortar business, which is also telling us that these are probably two very while there will be a little bit of an overlap, but we have two different need customers that exist. So there is a huge cohort of customers who like DMart but probably are not shopping in DMart, and they are now all going to DMart ready. So yeah, and
okay, and how are you getting the mix now in terms of home delivery versus store pickup, and is it possible for you to share the count of DMart ready store pickup points?
Pickup points have been mentioned. We don't split the revenue between the two. We don't split. See, our view is both will coexist. Both are equally important for us, and we are focusing on both right now. There could be an opportunity to calibrate pickup points a little bit more, so that the operating leverage that we desire from pickup should kick in. See, as a service, it's great, but at a financial modeling standpoint, it should work. So if it doesn't work, we will scale it down. Yeah. So to that extent, we are calibrating it, but we'll focus on both channels.
And Neville, any updated thoughts on private labels and on customer data leveraging? Now that you are collating all of this data through DMart Ready.
No, our position remains the same. So private label comments remain the same. It's a long game. We're doing fine. It's good, but we can do. We have to take a 10-year horizon probably in terms of how we want to build it. The team's focus is primarily on building great quality at great value.
But wouldn't the share increasing given the focus in smaller towns? I would assume because the customers might be a little more price conscious there. Private labels could be doing better. So on an aggregate basis, is share rising for you, even if gradually?
Marginally, but not really. Nothing for us to have a different strategy for small towns. Not really. I think this model is great if you have just one approach across all stores. It's more efficient, especially for a private label strategy. Okay, and nothing incremental on customer data leveraging.
No.
Not
Okay.
yet.
And the last one is this mini mass store format. Any feedback, experience, expansion plans here?
So again, it's a test. I think we imagine this format to play a more deeper omnichannel role in high-cost real estate places like Mumbai or Pune. So we're just testing it. So you buy from store, you pick up from store. Both these options are made available. So we're testing it from that standpoint.
Okay. All right. Thank you.
Yeah.
Thank you. The next question is from the line of Vivek Maheshwari from Jefferies. Please go ahead.
Hi, good morning, Neville and team. A few questions. So first, Neville, going back to the same, store additions. If you are talking about, let's say, 40 store addition, that will, that implies, let's say, about 11-12% on your base of stores right now. Where do you think, if you take a 3-5 year view, where do you think you will be happy? Shouldn't this number be more closer to 15% or even higher in the context of opportunity? And in that context, is there, you have, I think, spoken about it in the last analyst meet also, but how about, let's say, long leases, if you can get those, are you still averse to, making that a reasonable part of your total additions?
So I've commented last year also. Now it's not really about lease versus buy. The challenge is getting a 30,000, 40,000 square feet store is the issue, especially in the structure and form that we want. We don't go to malls. We'd love to go to malls, but we don't go to malls because of the ridiculously high rental costs. In fact, we were just discussing this over the last few months. If you see now, in fact, the funny part is in a lot of cities, especially in the large metros, you're seeing, I think the malls have become more and more premium in look and feel, okay, compared to earlier. And it's exactly opposite to what we want. These, I think someday the cookie has to crumble and we have to be invited, or we should be able to operate in a mall is my belief, but at an appropriate price, because currently the rates are ridiculous. I mean, it's extremely high. The rental values are too much. So that apart, then what are we left with? We're left with standalones. Or we are okay, let me put it this way also, that the real estate challenge is primarily in large towns, yeah, from a land and everything. And that's why you've seen that a lot of our stores have opened in small towns. So it's easier to get properties there. But the point is the business is also in large towns. If I want a 100 crore plus revenue or a 150 crore revenue store, or even a 200 crore revenue store, they're all available in large towns. I get my revenues very quickly there. So, and that is where the effort is needed. Yeah. So like I said, we are ready. I mean, we are working hard towards it. But yes, it's going to be tough.
So does that mean there is a period of, let's say, in the medium term, there's a possibility that the growth rate really comes off quite a bit. So if I just do a quick and dumb math of, let's say, 10-11% store addition and let's say 6-7% SSS, that means that you will be 15-17% kind of growth company. Is that good enough for you, Neville?
I would love to do it better. Definitely better. Not good enough for us, but obviously if we get more stores, obviously we are ready to open more stores. Not good enough, obviously. Like I said earlier also, single point agenda is adding more stores.
So as things stand today, Neville, so let's say 3 years out, so, forget about F24, 25, but whatever you can see 3 years out, can you add, let's say, a 60, 70 store sitting today? Is that what you can do, or you still will stick with 40 number?
It's not to do with my ability. When we say our abilities, I will say 80% is our operating ability. We are ready to open 60 stores per annum. We have that ability. But from a market standpoint, opportunity of real estate, okay, that pulls us back. Our ability, once we've acquired property, to build it, get all the permissions and open it, and then run it, 60 stores, very easily doable. We can do it. Okay, but will we be able to get 60 at a run rate level every year from the market for the next 2 years? I really don't know. Next year for sure nahi hoga. I'll also categorically mention that we will not open 60 stores this year.
Okay, and sorry, one more follow-up on the same question, because this is important from our modeling standpoint. So with all the excitement that I hear in my morning meeting around real estate and the property cycle, etc., there is a chance that the property prices may stay high, and whether commercial, residential, I'm just equating everything together. Does that mean that hampers and assuming that real estate cycle stays as strong as it is in the next 3-5 years, does that mean that store additions at DMart could be lower than what, let's say, the general expectations that investors have? So is there a risk on that front?
Because real estate prices going up?
I'm saying real estate, let's say the markets remain as buoyant as those are right now, and the prices remain as firm as those are right now.
Yeah, see, while real estate prices may go up, even our revenues have gone up. If you take a 7-8 year period of real estate prices vis-a-vis our revenues, I think if I look at it at a net level in large towns, I think our position is actually a little bit better than 6-7 years back from an ROI standpoint, Vivek. Yeah,
right.
It is just a question of getting those properties. Yeah. It's also a sense of, because of the typical nature of our buildings, okay, it gets a little bit difficult. So, and now, okay, let me give you an example of Mumbai. In Mumbai now, because FSIs have gone up so much, okay, we can make locations workable which were not workable in the past, because the builder has got that much more to construct. Okay, earlier FSI used to be 2.5. Now FSIs have gone further up, right? And then we can carve out a small space of 20, 30, 40,000 square feet, and at the costs that are currently prevailing in certain parts of Mumbai, we can make a DMart workable. But the sizing of of our stores are very different. So getting that alignment with the developer ecosystem is a bit of a challenge. But from a modeling standpoint or a availability of the current market price of real estate to our ability to buy at that price, I think we are slightly better than what we were 7-8 years back.
Okay, that's good to know. The other thing is, Neville, with the deflation that we are seeing, let's say FMCG companies taking down prices, and that's an important piece for you. And some of this may spread to as petchem prices. I know those are still volatile, but if those go down, does that also, concern you from a let's say gross profit per square feet or per store basis? Those prices may not look very good. So how do you think about that?
Deflation impacting us negatively?
That's right.
Yeah, see, when you look at deflation as well as inflation, on both sides, we are pretty well poised if it is not excessively high across all categories. Yeah. So, for example, let's look at edible oil today. There's been a decent amount of deflation that is happening. Okay, it has been good because there was excessive inflation last year. So, if you have excessive inflation or excessive deflation on very few categories, it's okay. I mean, we are just a pass-through, right?
Exactly. Yes.
So it doesn't matter. So when you have very large structural issues, then only it impacts us. Otherwise, either way, it doesn't impact us at all.
No, sorry, why? Because you are a pass-through. So are you then suggesting in a deflation, let's say theoretically, let's say the overall deflation, and again, I'm taking a very stretched number, but let's say if it is minus 5%, are you suggesting that, that will be offset by higher volumes and therefore the throughputs, as in terms of gross profit per store or per square feet doesn't go down?
See, every category or every item doesn't go to the same levels of inflation and deflation. That has been whenever we look at data. And we have a percentage markup principle, right? And if prices go very, very high, then we also recalibrate our margins downwards. So that's a continuous process. So, but in the larger scheme of things, there is no impact per se for us from a profitability standpoint. Because it doesn't affect every single category.
Okay, got it.
The blended average, my point is the blended average doesn't get distorted too much, Vivek. Maybe a few basis points here and there.
Got it. And two more, if I may. One is, on slide 10, where you have revenue from sales, per retail business area. So if you look at F19, 35,647 versus 31,096. So Neville, if you just, keep the stores constant as at 31st March 2019 and look at today's number from the same set of stores, is that number higher, reasonably higher than where it was in F19?
I don't know where the question is trending to, but I have not done the math the way you are mentioning. But I think the better way to look at it, Vivek, is look at SSGs. Okay, we are quite... SSG has softened for sure. Okay, but we are... nothing is declining. Everything is healthy, growing. They are, like I keep saying, the older stores are close to inflation or slightly lower than inflation. Whereas these stores are not doing too well, it's primarily because you have another store open close by. Yeah. And otherwise, our belief is that we've opened larger stores just to accommodate more traffic, number one, for the longer term. And the second thing is also to experiment and try more and more categories, the non-FMCG space.
Okay. And last question, I don't know, again, it's a fair question or not, but Neville, with all the issues that we are seeing in, let's say, general merchandise and apparel, and if I just, draw, and again, as I said, pardon me if the comparison is not correct, but when I look at Meesho, around the same time, let's say Meesho has moved from zero or maybe $500 million GMV to about $4.5 billion GMV. Is there a possibility that some of DMart customers may be shopping general merchandise online because there is value and there is convenience also, or that is a bit of a stretch in your view?
I have never claimed that we have exclusive right on our shoppers. Okay, there is no sense of exclusivity at all. I'm quite certain. In fact, in my own home, we try everything, right? I mean, and that's the way it is. That's the power of a free market. I mean, what else do I comment? Yeah.
No, my only point is, general merchandise apparel, is it a macro issue, or is there, so you mentioned about competition from an offline space, in the offline space, and what about, let's say, someone like a Misho who has moved from $500 million or thereabouts to about $4.5 billion in literally 4 years, and provides convenience in term, and value, I don't know the product quality, but at least pricing wise, is quite competitive. Does that worry you from a competition standpoint?
The only thing that worries me is that why am I not adding more stores? So my point is that I don't know about others, but the market is so large, it's available for everyone, it's available for me. Whoever does whatever, 5x, 6x of revenue, or maybe 8x of revenue, great, good stuff, well done. But is it impacting me negatively? Not really. Is there a churn? Of course, yes. Some people are dropping off, some people are buying more and less now from DMart. But I'm also getting new customers who are trying me and buying me. I'm getting a set of loyal customers. The point to make is that the market is extremely large. When should I be worried? I should be worried if my overall business at a store level is not doing too well. And from that standpoint, like I've already commented, we are very confident on the general merchandise space. We've already more or less come back there. FMCG space is doing lovely. It's doing fine. Apparel, yes, we have work to do. Yeah, it is a macro issue, but it's also an internal issue. So we are working on it, and that's life. I mean, some years you don't do well on certain things. You lose sight on certain areas. We're working on it. Yeah.
Got it, Neville. Thank you very much for your responses. Wish you all the best.
Thank you so much.
Thank you. The next question is from the line of Amit Sachdeva from HSBC. Please go ahead.
Hi. Thank you so much for taking my question. And Neville, thank you so much. Much of the questions have been answered, but let me go back to general merchandise and delve a little bit deeper there. So if I look at, come what may, I think the DMart has a great appeal. There's a larger footfall, and whether you like it or not, fashion has become still larger part of the revenue, right, in that merchandise. And I would hazard a guess that probably you are still one of the largest fashion retailer in the country, which is organized, even though you are not intending to be one. You're a grocery retailer and you want your choice to be very clear that you want to do those things that doesn't require high fashion content and offers great value, which I totally agree with. My question is that, while the value retailing principle that apply to grocery, wherein, consumer instantly feel that he's getting consumer surplus or getting delighted with the prices being offered and good being standard, he can compare across. Fashion and merchandise is not so much so. But I also observe that in this quest, the cheap has become little inferior. Because, if the quality of good was superior and the prices were low, there is a consumer delight happens. This has become a little challenging in probably merchandise. Do you need to rethink about those principles as well? Because fashion has probably been not attended that well. Even general merchandise, other than fashion, needs to completely rethink about sourcing and also better marketing in the store. I know you're not a fashion retailer, but it would require slightly harder selling in some sense. So is there a lot of work to do here? You need to rebuild teams, build rethinking. What is the steps involved in as you deal with that? Would you tell us a little bit how you plan to shape this, please?
So Amit, you answered the question yourself. That's how you run businesses, right? You have to look at people, competencies, market, customer, and one thing which we keep talking about internally is pre-COVID, post-COVID. Pre-COVID to post-COVID, I think everything has doubled more or less. Mm-hmm. Yeah, revenues, number of stores, or at least 70% more, right? So while we were not in the best of action because there was work from home, you have COVID disruption, all of that. But suddenly we all come back to work, and we have to realize that the company has changed a lot from what it was pre-COVID.
Sure.
You actually, and people sometimes don't get it, that so much has changed. Yeah, we've added so much more stores, so many more distribution centers, so many more people. Yeah, so yes, it has created significantly larger challenges for us. But I think when you have a challenge, you have to work towards getting it right. So we and generally when you go through a rough patch, it's probably the areas that are not very strong get impacted the most, and that's where apparel has impacted us more. But we'll work on it. I mean, and general merchandise, I don't think, and that's our bread and butter. We understand that very, very well. And our view there is there's no quality or a customer standpoint challenge. Okay, it was more of a macro issue, which is getting corrected over a period of time, and we're very confident there. Apparel needs more work.
Neville, the reason I asked this question is that just wanted to fathom how large is the problem according to you, and how much time will it take to sort of address it? And thirdly, whether the impact of that headwind, whatever that headwind is, macro or bit of a other structural piece part of it, has it been bottomed out and you're seeing more flattening base there, or you're seeing still continued store level headwind coming from the apparel side? That's exactly what I wanted to know, to be honest, in that question.
So Amit, you've seen the financials, right? I mean, I hope I get more questions than just general merchandise and apparel, because end of the day, this is going to impact your gross margin and PAT, by a few percentage points. Yeah, I mean, you've seen the numbers, you see the trend line.
Sure.
So it is not. It's an issue, but it's not so much of an issue. Yeah, we're working on it. And like I've already mentioned, apparel is a smaller contributor compared to general merchandise.
Understood. And second, if I may, Neville, you made a comment that for network rollout, there's a large town focus where there's a vertical development, because that's where you see larger opportunity. And has that thinking shaping your network rollout as you go forward? And if that is a construct, are you more keen to go in the larger towns and less so in the smaller towns? And if that's the case, if you could just hazard a guess, in how many years that you could double the retail area that you have, given the construct you're thinking about this? Not really asking for a store guidance, but broadly, as you double your business, in how many years you think the area will double, thinking about this construct?
So Amit, looking at the size and the ability of the balance sheet, we can go large town as well as small town at the same time, especially in the states we already operated. So there is, while like I mentioned that from a financial standpoint, obviously having more stores in large towns is better. But that doesn't mean that the small town opportunity will not be captured or will not be harnessed. We will be doing everything. Yeah?
Sure.
The balance sheet allows us to do that. And for the rest of your question, we always don't give our projections. I keep saying this: judge us based on past performance, and that is what we will stand by.
Sure. Would you look at smaller stores if you were to go deeper into like a 10,000 square foot store also is okay rather than 30,000 or 40,000? Or
2 years back also you asked me the same question. And
yes, I'm just asking again just to reconfirm.
So 10,000 is fine, Amit. You give me 100 stores in Bombay of 10,000, I'll open all 100.
Okay.
Get it, right?
Brilliant. Thank you so much for that.
Yeah.
All the best, Neville.
Thank you, Amit.
Thank you. The next question is from the line of Richard Liu from GM Financial. Please go ahead.
Hi, thank you for taking my questions. Number one, Neville, if I use the bill cuts data that you provided, and I divide that by the average number of stores, that you have in various points in time, what it tells me is that your average footfall per store per day and I'm using average because I don't have further data. So this average per store per day is down from about 2,800 odd in fiscal 2019 to just about 2,300 odd. So that's about a 17 to 18% decline. You made up for this footfall, shortfall as your basket value is now much higher. Can you throw some perspective on this kind of behavior, please? Did less number of people visits have any impact on general merchandise, etc., given that there is also an impulsive component to that? And do you expect this behavior of lesser number of visits but higher basket size to reverse anytime soon?
So Richard, I commented earlier, but I'll come with precise numbers. See, 10 lakh plus towns, the number of stores contribution in financial year 20 was 69%. Yeah. So we had only 21% stores in 10 lakh below towns. That has moved to 28%. So a larger chunk of our new store additions has come in smaller towns. And this number that you commented is simply because of that reason. Smaller towns, lesser footfalls. So that's why the blended average has come down. Obviously, notwithstanding that post-COVID, the average basket values have gone up. So that also has an impact. And that is where I come back to the same question, same point of view again, that we track our SSGs across all stores, store by store, or even by vintage. Yeah. And from that standpoint, except for the apparel side or the general merchandise side area, the general footfall, the general revenue of all the other categories are growing robustly well. So no worries there. Yeah. So again, footfall to the store is not a challenge, but once she's in the store, the ability to convert them to general merchandise and apparel has weakened, and we are working on it to make it better. So the belief in the model is there. It's just that we need to get these areas sorted.
And these guys from the non-10 lakh plus towns are also shopping with a higher basket size as in the others?
Sorry?
One reason you gave is that the number of 10 lakh plus town stores are much lower in proportion. My question is that that between these two periods, obviously the number of the size of the basket has gone up significantly. So since there is a higher component of these smaller pop towns, are these guys also shopping with a much higher basket size?
Basket sizes have relatively gone up across all categories, all pop strata towns, but the average basket value in a smaller town is significantly lower than the basket value of a larger town.
Which basically means that if I take FY 2019 to be constant, for those cohort of stores that were existing in FY 2019, would the basket size have been significantly higher today than what they used to be, let's say, 3 to 4 years back? So if I was just stretch my imagination a bit further, the other question is that are these guys who are buying more and much more per visit a different set of people than the ones in 2019 and earlier? What I mean is, does your customer cohort also now comprises many more shopkeepers buying a lot of stuff to stock in their stores versus, let's say, end consumers like you, me, and our neighbors?
So you're asking whether there's a B2B element in our business. No, not really, Richard. If that's what you're alluding to, no. Because if that was the case, then FMCG, the mix of margin would have come down. That's not the case. Our gross margin has come down because of lower contribution in the general merchandise and apparel business. And also to a certain extent, we have taken certain deep cuts in certain categories within this subcategories within this GM and apparel business, and that's why there's been a deterioration in gross margin. But there has been no deterioration in gross margin in the FMCG side, and hence no reason to interpret that high basket values is because of B2B. We also tightly control it. You try yourself, go to any store and try and buy 1 carton of Coca-Cola 2 liters or buy a carton of washing soap. See, and tell me what happens at the cash counter. Quite likely they'll stop you.
Okay, got it. And just related to what you mentioned about gross margin level, if I look at earlier times when you had 28% share of revenue from general merchandise, etc., versus now at 23, Your gross margin, is not very different, right? And I'm talking about consolidated gross margin. It was 15% in FY19. It is still at 15.1% for FY23. And so how did this happen? Are you earning much higher margin on the balance 75% of revenue?
I will not comment on console. If you ask me on standalone, then maybe I'll be able to comment.
Yeah, so that's 20 bips difference. It's 14.7 earlier, now 14.5.
Okay.
For a 5 percentage point change in general merchandise share.
So come back to the question. Sorry, come again.
What I mean is that your general merchandise and apparel share has reduced significantly from, it used to be 28% earlier and it's 23% now, right? I mean, so that's a 5 percentage point reduction, which is pretty significant. But if I look at your gross margin in the standalone business, at that time when the share of general merchandise was 28%, it was, I think, 14.7% if I have my numbers correct. And in FY23, with a much lower share of general merchandise, you're still earning 14.5% gross margin, right? I mean,
excellent. Yeah, brilliant observation. But my sense for that is, Richard, I don't have a straight answer for it because during this period, we've been transitioning from direct store delivery for a lot of vendors to DC deliveries. And there's been a lot of, the blended average of gross margins that we earn have gradually changed across all categories over time. So that's why you're seeing that. And so let me put it simply. Suppose Hindustan Lever gives me 10% gross margin, but he's delivering at my door through a local distributor. Now I go back to him and say, look, I need my delivery at my DC, and I will do the deliveries myself. You get a significantly better margin from these companies, which not only covers the cost of dispatch or managing all that, but you also make a few percentage points more. So this was over the last 5 years in the FMCG side, there has been this blended change. Okay, I hope you're getting what I'm saying.
Yeah.
And that's why it's not comparable. So it's a brilliant observation, great point, but the response is this because this is what has happened, and that's why the loss of margin on non-FMCG has been compensated by this going direct on the FMCG side. Got it?
Yeah, and do you have any such other tricks up your sleeves to improve gross margin other than through general merchandise and apparel?
Not a trick. I told you what really happened.
No, sorry, wrong use of word. I mean, any other such leverage that you may have in the future which can help you in gross margin?
Not really.
So now the only choice is to get general merchandise and apparel up?
Yes.
Okay. Got it, Neville. Thank you very much. Wish you all the best.
Thanks.
Thank you. We have the next question from the line of Varun Singh from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So my question is on the apparel side of the business. I understand that you already highlighted about the problem which exists and the people, portfolio, category management that we need to solve for. But still, if you could also, of course, the point that you mentioned about not selling lifestyle product but daily wear product, all that taken into account. But still, having said that, apparel as a category is still aspirational, no matter how much deep down the value we go. I mean, even if you take products like innerwear, etc. And of course, all the companies are selling at all the price points. But having said that, for example, if we look at the visual merchandising or the trial rooms, it goes beyond just the product that we are selling or the employees who are engaged with the customers. So as Richard was pointing out earlier regarding more hard selling, etc., just wanted to pick your thought or understanding on how we are solving for the problem in the apparel over and above just the product, getting the product and the price point right. Because of course, as we say that selling cheap is different than selling value.
Varun, right? Varun.
Yes, sir. Yes, sir.
So Varun, we are very clear about one thing, that we can't be everything to everybody. Yeah, we are distinctly stand for something, and we'll stick to that positioning. We can't create a very aspirational environment for apparel business when you're already buying groceries and some rice is falling here or some ghee is falling there, so things like that. And we don't have very expensive lighting, and we don't have expensive props, and we can't do that. So there's no point trying to say that we'll try to create a great shopping experience from that standpoint. Nonetheless, wherever there are opportunities to make the basic look and feel better, obviously we'll make it better. And at the same time, like I said, look at it from a business modeling perspective. Even if a few percentage contributions go down on apparel, it's okay. I mean, there will be other opportunities in the overall scheme of, the non-FMCG space that we've still not looked at. As the economy grows, if GDP grows at 7-8% or 6% per annum, it will constantly the market will throw opportunities for us to sell a lot of stuff that we're not selling today. So I think we have to use that lens and think about, okay, what else can we do there? Rather than just talking about, how do I retain my apparel contribution to the overall business? I mean, we'll try as much as possible, but there are so many other levers to look at. That's the way we are thinking about the business.
Absolutely, sir. Got your point. I just wanted to kind of understand, I mean, in case you are thinking of scaling down the degree of the business, the category, I mean, of course, a category you all already talked about, but the retail area which we kind of share for this very category, given that pharmacy is a new category that we already ventured. So, I mean, any comments on those lines with regards to the area that is dedicated for this segment and going forward, I mean, the category that we are looking at, and any thoughts on that? And also, if you can share comment on how pharmacy is tracking in the existing stores and scale up as a consequence, how you are thinking about scaling up this category as well.
So pharmacy, to comment is too early. Again, we have to open at least a sizable number of locations, and then the financials itself will tell you how we are trending there. So that's on pharmacy, but we are pretty confident on pharmacy because we used to run the pharmacy business earlier. I think at least 6 to 7 pharmacy stores is what we used to run at one point of time, and then we decided to shut it because we wanted to focus on the brick and mortar business. But we are very confident that pharmacy will do a decent job. On impact of retail area because of lower performance of certain categories, I've said that again earlier also, that the model is very agile, very flexible. It's like a Lego blocks. I mean, whatever you want to do, you can do. You want to reduce space, you can reduce space. You want to increase space, you can increase space. The incremental construction cost of the building doesn't impact the viability of the store. So all those levers are available, and depending on case-to-case basis, location, region, we will keep modulating the area, the space, or whatever that we want to, on the higher side or the lower side. Yeah, in a lot of locations we build more, but we don't open that floor. We wait for some time. We wait for the revenues to come up, and then we open those additional spaces. So all those options are available.
Got it, sir. And the last question on the new cities, the geographies, and all that we are kind of venturing out to add stores. Looking at number of cities, etc., that we have ventured out in the current financial year. So we have kind of narrowed down our focus more to the existing cities. So, I mean, is this because of relatively lower performance when we are venturing out in the new geographies? I understand you mentioned about NCR, Punjab, store economics tracking equivalent to all West or system level average. But still, also, for example, you had said that you'll be more than happy to open 10,000 square feet stores given an opportunity. So, I mean, looking at these two contexts with regard to the store sizes, which, I mean, of course, we have also gone more conservative, given in recent quarter we added 40,000 square feet. So just wanted to pick your mind with regards to what is the ideal store size that now we are looking at, 40,000 versus 10,000, as well as the new cities that we are choosing to venture out while we are doing all these incremental store additions.
So, if you are alluding to the last quarter 3 stores that we opened at 30,000. There's just 3 stores. Yeah, we are still quite confident on opening larger stores. Yeah. So that from that standpoint there is no issue. Yeah.
And on geographical expansion?
Geographical expansion, there's an operating leverage now, Varun. That's why we say that we'll open more and more stores in the same cities, because you get fantastic operating leverage, you know. So that's why we like to do that. But we also open now to spend a little more and open in cities which are a little bit away also, right? In new cities. We do that also.
Got it, sir. Understood. Thank you very much, sir. That is it from my side.
Thank you. We have the next question from the line of Ashish Kanodia from Citigroup. Please go ahead.
Yeah. Hi, Neville. So the first question is, when I look at the revenue per square feet, say in FY19, which was around 35,500, and FY23 at around 31,000. And if I just, look through your earlier comments in terms of, going into smaller towns where, the revenue per square feet is lower, but the cost is also lower. So just, is it fair to say that, this is the, the store mix, area mix which you had in FY19, that was the, that was the revenue in FY19, and now in FY23, when you look at the, revenue per square feet, it's fundamentally purely a function of, the store mix and nothing from a, what we keep hearing about competitive intensity and other stuff. So is it fair to say it's largely only a function of your, store mix, area mix from a large, smaller town, largest town perspective?
Ashish, I've commented on this before. I'm saying this again, that see, for us it is ROI of the store. We invest in the store and we look at the revenue, we look at the gross margin, we look at the cost of running the store, and we see that whether we make a profit. Now, for whatever reason in that store, for that city, the contributions of general merchandise apparel are different from others, or gross margins are different from others. That's part of that city or that market, right? For us, what is important is ROIC. Are we making money in that store or no? Okay? So from an individual pop starter standpoint and a state standpoint, every state has a very typical behavior. Okay, the gross margins of certain regions are relatively different from other states for whatever reason, right? But it is a fact. Maharashtra gives you a different behavior, South gives you a different behavior, Gujarat gives a different behavior, North of India gives a different behavior. But the point to make is that in the overall scheme of things, are you making money? Yeah, and then like it typically happens, certain states allow you to make more money, certain states do not allow you to make that much money. Yeah, from an ROIC perspective. But does that mean that you say, oh, if one particular state is giving you a significantly higher ROIC, I should drive that in the other states? I'll not try to do it by nudging or doing something out of the natural behavior of the customer. We'll look at, okay, are there any white spaces? Are there any gaps? What is it that's working well in Maharashtra, or what is something that is doing well in Karnataka, where we're doing well, and can we do that there? Yeah, through a slight nudge. But that is what we do. I mean, and like I said, we don't look at revenue per square feet, as a metric internally. We don't even evaluate our people on that front.
Please go ahead.
Yeah, that's it. I mean, for us, fundamentally is, gross margin, operating cost, net margin, ROIC. That's it, per store.
Sure. Secondly, on that pharmacy, right? So you have done it earlier, so the model works, right? So from a existing store point, is it how difficult or easy it is to set up within the existing stores? Because when I look at the one store where you have kind of tried in the Minimax, right? It's basically there's a separate area being carved out and maybe a SKU thing, right? That the products are very small. So just trying to understand, while you may build it up in the newer store, but existing store, is it still the Lego model? Relatively easy to plug and play and scale up?
For the pharmacy business, right?
Yes.
Absolutely. It will be part of a store. Yeah, there shouldn't be an issue at all.
Okay. And lastly, I mean, just on the general merchandise and apparel, my understanding is, when I look at, say, the DMart Ready business, right, it's predominantly your non-general merchandise and apparel business, right? And then when you look at the standalone business, almost 3.5% revenue comes from sales to, the e-commerce business. So is that also impacting your, general merchandise and apparel mix? I mean, if the understanding is correct that it's basically, from the standalone you are doing some related party sales to DMart Ready, and that are purely your foods and non-foods. So there is an impact from that as well. So is that understanding correct?
Partly, but that is inconsequential from the overall impact for gross margin. I mean, the general merchandise and apparel contribution to business. No. So your interpretation is not correct. Inconsequential.
Okay. Got it. And just lastly, you talked about, operating leverage, but you're also getting into, maybe further into faraway cities. Now, in terms of, I'm just trying to understand this, right? Maybe in existing, is it relatively easy to get real estate in maybe, if you go to a new state versus maybe trying to get a real estate in the existing cities where you already have, say, 4, 5, 6 stores? And if it is relatively easy to get, real estate in some of the newer states, will you look into, kind of expanding more, maybe at a cost of a bit of operating leverage?
I think the lower the pop strata, easier to get the real estate. That's broadly what our sense is.
Okay, done. Thank you so much.
Thank you. The next question is from the line of Manish Poddar from Motilal Oswal AMC. Please go ahead.
Yeah, hi. Thanks for doing the question. Having 2 questions. One is, Neville says you have to open 40 stores in a particular year. Would you be able to help me understand how many stores need to be vetted and how big is the team who takes the final call?
Manish, sorry, your line is slightly unclear. You said, what does it take for 40 stores? We couldn't follow you.
So
Mr. Poddar, I would request you to kindly use your handset to ask a question, sir.
Yeah, sorry. Is this better?
Yes, sir. Please continue.
Yeah, sorry. So I'm just trying to understand, let's say if you have to open 40 stores in a particular year, how many stores need to be vetted and how big is the team who takes the final call of, taking the property?
So it's a multiplier. It's not like okay 50 देख लिया तो 40 हो जाएगा. It's more of a multiplier. So for example, if for every 100 properties somebody shortlists, 50 goes to the next level, then another 25 go to the next level, then eventually you may end up only, the sales deal may happen only for 10. It's like that.
So 10% is the conversion rate.
Sorry?
So conversion rate is roughly 10%. Is that how it is?
No, I'm not telling you that. I can't give you a clear number there. But I'm saying the initial shortlist to final closure is a humongous effort. It's a long. I mean, it goes to 3-4 stages, so it's a long effort.
And how big is the team who takes the final call? Because from my checks, it suggests it's very closely.
Big enough to open 40 stores at least.
Okay. And just a second one. So in terms of private label, has there been any change in terms of, let's say, one is internal in terms of number of SKUs across categories which you foray into, and second in terms of consumers' habit for that category. Has there been any change? Let's say now you have more cleaner, no non-COVID numbers. So has there been any change both from our approach in terms of SKUs available across categories and in terms of both consumers' habit? Any change in that, let's say from a structural point of view? Thank you.
So nothing much has changed. We are just focusing on private label from a standpoint of 2 things. How easy is it for a consumer to accept a private label or an unknown brand for trial and then for regular use, consistent usage. So from a consumer standpoint, which is the easiest to cross that barrier? We look at that. And second is we look at what is our ability to ensure that we maintain that consistency in quality and at a price which is significantly discounted to the main brand. That's it. So from that point, again, I keep saying that the progress will always be incremental and slow. We can't do a big bang here on the private label piece.
Got it. Great. Thank you so much.
Yeah.
Thank you. The next question is from the line of Nihal Mahesh Jham from Nuvama. Please go ahead.
Yes, thank you so much. Good afternoon, Neville and team. Neville, I'll be starting off with a question on GMNA. Just to understand, would you say that there has been a bit of a change in the customer profile that kind of shops at a DMart? Because we see the change in metrics, and rather than being an assortment issue, maybe the kind of customer who's walking in is different and potentially shopping for a lower share of GMA. Is that something that maybe you picked up or anything related to that?
Not really. I think, in fact, no. I think the customer profile remains the same, but within that customer profile, I think there has been some tightening of the purse on the GM and A could be the reason, especially A. The inflation, we went through a huge surge of inflation, and that I kind of disrupted a lot of things. I think the segment of customers we address on the GM and A got hurt more acutely on inflation, and that could be one of the reasons why. So customer profile didn't change.
You believe that stays the same because, as we've discussed through the call, that metrics in a way of how ABV has moved, how footfalls, all that, while you mentioned about opening in tier 2 cities and all those, but you believe that the customer profile is more or less similar to the way it was pre-COVID.
Yeah. I'll tell you some insight on the apparel business. Very interesting insight. We have a huge chunk of basic products that we sell, and during a high inflationary period, it was that segment that just got butchered. It just got beaten badly. However, the mid to expensive pricing was doing phenomenally well, but it was not compensating for the basic product loss. Now what is happening, because prices have corrected and all that, it's a reverse. Yeah, we are getting a lot of this basic segment sales coming back with a roar. Yeah, so this is all demand, supply, price elasticity that is in motion. But only thing is there are so many things working at the same time. That in the blended thing, we have to give it more time. I think probably a few more quarters, and we'll have a more clearer view on how apparel is trending. But we are now seeing a lot of the sales coming back from all the entry price points.
Got that. That's very helpful. My second and final question was on DMart Ready. We've obviously discussed how large maybe the contribution for Mumbai is. Taking the focus to the other two cities, which is Pune and Hyderabad, where we have a large store presence, and the fact that we've been present in these cities for a relatively longer period of time, and the brand DMart is also very much known and visible. So is the share of these cities also seen a reasonable uptick? Because, that is where the dichotomy is coming, that while Mumbai has scaled up, but Pune and Hyderabad also are in a way our bastion cities, and that should have also seen a good traction over the last few years.
You're absolutely right, and we're quite pleased with how they're trending. Like Pune is Pune, again, it's our ability to quickly accelerate the fulfillment center closer to the markets. Then that will give us phenomenal sales. So it's just our scale up. And Bangalore, Hyderabad are also trending decently well. So if I talk about Pune and Bangalore specifically, yeah, in fact, from a time to performance period relationship, it is doing better than Mumbai. So if I take what Mumbai was 2 years after launch versus what Pune was 2 years after launch, or Bangalore was 2 years after launch, they're doing a better job in the newer cities compared to Mumbai. That's what I'm saying. Vertical, large towns, immense potential for our kind of e-commerce business.
Sure. Just a related question. So the share of Pune and Hyderabad and Bangalore, as including, has improved over the last 3 years, if I put it as that.
Yes. And without any impact to the brick and mortar business. And that's a huge positive.
Point taken. Thanks, Neville. Best wishes, sir.
Yeah.
Thank you. The next question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, Neville. My first question is on inflation. Vivek touched upon it, but I just wanted to sort of ask once more. See, as you say, because you are a pass-through, if the inflation comes down, doesn't that sort of negatively affect your SSSG? Because let's say, hypothetically, last year, if there was a 15% YOY inflation in atta, person was buying the same 1 kilo but 15% higher. This year, if the inflation comes down to 5%, then the growth in his spends is now only 5% for that category. And as you say, it matters which category, what is happening, but on an average, generally inflation is coming down. So don't you think that will affect your SSSG? And if the gross margins are fixed for each category, then it will affect your profitability or rather profits also.
Yeah, it does, Percy, but it's all in basis points because all these crazy increase, decrease in certain subsection categories is only for that. Like, for example, wheat will go up by 40% in a year, yeah, or something else goes down by 20% in a year. But overall, at a blended level, okay, inflation, a high inflation is 8%, a benign inflation is 3 or 4%. So we factor in that when we look at our SSG. What was the inflation-driven SSG and what was real volume or walk-in or whatever.
Let's say, supposing if inflation last year was, let's say, 6% and this year it comes down to 3 or 4%, it's not a very big difference. But 200 to 300 basis points difference in SSSG, at least for the grocery part, which is 77% of your business. So if, let's say, your SSSG normally is 8 to 9%, it can come down to like 6-7%. Does that make sense, or am I on the wrong track?
Makes sense in what way, Percy?
So what I'm saying is that if inflation comes down by 200 to 300 basis points, is it fair to say that in the non-GMA portion, which is 77% of the sales, the SSSG for that portion also could come down by 2 to 3 percentage points versus what it would normally have been?
Yes. See, the way we look at SSSG, we always factor in what the inflation has been for that year, and then we make a judgment on how we are performing. Yeah. So we take inflation out of the picture when we evaluate how well a store is doing on an SSG front.
Understood. But from a FY23 versus 24, because FY23 was a high inflation year and the SSSG was what it was after that high inflation, FY24, could it see some moderation in SSSG versus what it was in FY23, especially for the 77% of your business is what I'm talking about?
That is this year, right?
Yes.
Yeah, there could be. There could be, and we're also seeing some of that. Yes.
Okay. Understood. And that would also affect your profits, right? Because your gross margin would not change because of this.
That all I don't understand. You guys are better at all this. You figure it out.
Okay. Understood. Secondly, just wanted to ask, in your annual report, I see that you have opened a few of these Mini-Max stores. If you can just give some idea, what is your sort of vision and strategy on that format?
Yeah, so I responded to that in the earlier question. We believe that this format could have an opportunity from a pure play omni-channel perspective. So it becomes a pickup point, and it also becomes a location to buy directly from the store. And our view is that from a ROI or operating metric, it could be a slightly more efficient model, especially in high real estate areas. So it's just a trial, but we housed it in the e-commerce business because we believe that their ability to integrate online, offline, shop online, pick up from store, or maybe in the future even pick up from store, shop online, and the delivery boy picks it up from store and delivers at home. So all those possibilities can be activated, and that's why we are doing this as a trial. Let's see.
But as of now, you don't see it like becoming a important growth driver, like you can open 150, 200 stores of these kinds every year or something like that?
DMart was never built with these grand visions. We play it one day at a time. We do trials, tests, it's typical that, what do you call it? Crawl, walk, run, right? I think I learned all this from the IT guys, yeah, something like that. So we'll do small trials, we'll see how it goes, and then we'll do a larger trial and then see. Yeah.
Understood. Last question is on the CapEx. So if I do some calculation based on your annual report, the CapEx per store is roughly 25-30% higher than FY22 in FY23. So just wanted to understand what is the reason for this, especially because you are opening more stores in smaller towns now.
See, I'll not give a percentage incremental because of the way you add capex in the balance sheet. But yes, in general, the trend line is the cost per store is getting higher compared to the past.
And this is pure real estate inflation, or it's a function of the store size being larger?
It's both. It is cost of real estate, and it's also the size.
Okay. Thanks, Neville. That's all from me. Thanks and all the best.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for the opportunity. So my first question is with regards to the DMart Ready site. Since your DMart Ready stores are largely into the major towns of Mumbai and Pune, etc., and most of your older stores also in these regions. So is there a possibility wherein customers are now shifting more to the DMart Ready stuff, and then they have a limited basket size, limited basket or they run the basket assortment basically that they run, and hence this is in turn impacting the sales of general merchandise and apparel because they are buying these online and not visiting the stores?
Could be possible. See, more and more e-commerce discovery on general merchandise becomes more and more. There could be a shift on that side of the business from our stores to these other avenues. Possible. See, that's why our belief is on the general merchandise apparel business. If you ensure the value is great, good quality products at great value, and I don't think e-commerce can deliver that. See, what does e-commerce do? It just discovery is awesome. I mean, you're browsing through social media, you're browsing through some sites, apps, whatever, and constantly something or the other pops up, and then you like something, you click, right? And that's the beauty about what happens on your mobile phone. What we are saying is that what we should focus on is that get the customer into the store. What is it that will bring her there? And once she enters the store, buys the groceries, and she then discovers or goes and sees the general merchandise and apparel products, when she sees the products and she figures out what she's paying for it, I mean, it should be a significantly higher wow. And that significantly higher wow comes because the cost of delivering that product. I keep saying this, factory to store to consumer. Tell me a model which is better than that. So if I have my assortment very sharp, try to be very wide horizontally in as many categories as possible, but few products, few choices, okay, and give great products at super efficient prices. E-commerce can't beat that. E-commerce is all about long tail. I mean, it's all about long tail, but very, very high margins, because they otherwise can't deliver that product at homes at those prices, right? And with those limited small volumes. So that's why I keep saying that we have to be significantly divergent in the way the products are sold on e-commerce from a positioning standpoint. And then you'll get the customer, you'll get the stickiness.
Sure. So my question was actually, that because we have now DMart Ready, and this DMart Ready is offering more convenience to the customers who are already shopping from the DMart stores physically. So now these customers are not going to the stores, and because of which, the sales of general merchandise and apparel is getting impacted in your stores. So that is what I was meaning, rather than, competition from the other e-commerce players.
No, yeah, I got that, but doesn't make sense, no? Because the share of general merchandise and apparel is not going down because of that. The share is going down because people are going to the stores and not buying enough of the general merchandise and apparel as earlier.
Okay, sure. And so my next question is with regards to the.
But there is an element of truth in what you're saying, purely from the standpoint of the number of footfalls that have come commensurate to the incremental basket values that have gone up. So the chance of a customer getting exposed to general merchandise and apparel has reduced. Yeah. So to that extent, maybe. Yeah. Only but to that extent.
Okay. Sure. And so my next question is with regards to the, if I look at, the OpEx per square feet for you. So in FY20, it was roughly around 2,300 rupees per square feet. But now if you see in FY23, it comes to roughly around 1,930 rupees or 50 rupees per square feet. So, this has come down considerably over these past years. So anything particular that we are doing which is driving these operational efficiencies or anything that you could highlight on this front?
No, not really. It's just a base effect. It's just because you open larger stores. And secondly, like I mentioned earlier also in last analyst meet, when you have lesser footfalls, all costs of the store come down. And one of the main costs is our energy costs. So that it is just a base effect thing. It's just because number of bills have been reduced and store sizes have become larger. It's just that. Nothing in particular that we have done or we have consciously done to reduce costs.
Okay. And sir, my last question is in terms of the opportunity, in terms of the existing town stratas. So like a city like Mumbai, we would have a higher number of stores versus the newer geographies that you are entering into. So how is the focus in terms of the percentage store opening? Would those be in the newer towns or the cities that you have recently entered, or this will still continue to be in the existing cities more, followed by the newer cities?
So whatever comes first, teams are operating everywhere, but generally the trend has been that we open in cities that we already there, bulk of our revenues and large towns. So we're focusing on that. And then obviously now the new focus area has been the north of India. So we're focusing on UP, NCR, Punjab, so Rajasthan, a lot of stores coming there. So we're focusing on that. And like I said, large towns, Bangalore, Hyderabad, these are stores which can take probably 150 stores of DMart. Each city can take that kind of number of stores. So we're working on that too.
Sure, sir. Thank you, and that's all from me.
Yeah.
Thank you. The next question is from the line of Nikunj Kala from Sundaram AMC. Please go ahead.
Yeah. Hello, everyone. So just one first question on the ROI front. Say if tomorrow we want to pivot to the new store only dedicated for the food FMCG and non-food FMCG, then just want to understand how the ROI will be different from the two front. One is the capex intensity or capital turn perspective and the operating margin perspective.
This is very hypothetical, theoretical, Nikunj, but fixed asset ratio will be very high.
Right.
Store size will be very low.
Right.
Gross margin will be significantly lower.
Yeah.
Operating cost will be also relatively lower. And net margin, that will be relatively lower than what it is, if that's what you want to know.
So at a ROI level, will it be very different from the today's construct, or it would be similar in nature?
I cannot comment on that.
Okay.
All I can say is that we'll make money even then.
Okay, sure. And secondly, when we mentioned there is a huge opportunity out there, if I just take a two segment, food FMCG and non-food FMCG, in non-food FMCG today, the category in which we are working, it's a market is 2 lakh crore, where our revenue would be upwards of 8,700 crore from FY23 numbers. Then we have a significant 4.5% market share, and despite not being present in many parts of India. So if I just consider where you are, then this market share will be very formidable. So do you see or from the market share perspective, what is the number you think that would be doable?
And my only view here is that these are not things to be worried about. You are saying 4.5. I don't know what the real number is, but when 95% of the market is available, it's a gold rush, right? You just go ahead and open wherever you can open. I don't have a modeling or I need to be this percent of the market and that percent. Doesn't make any sense. I should be growing at my current ways. My top line should grow at a current at a particular rate that we should be satisfied with or happy with. A number of store additions should be at a rate that we're happy with. Our new store addition should not in any way make our balance sheet weak. Things like that.
Sure.
So those are things we'll look at. How do I sensibly grow? Market is not going anywhere.
Okay. And just lastly, on if you enter any particular state, typically what is the number of years you believe that to understand the consumer behavior in a particular state, and to then like you mentioned, crawl, walk, and run, and in the year in which you believe that now you can expand very significant rate?
I think 3 to 4 years. 3 years is a good number to look at for a brand new state.
Sure. Okay. Yeah. Thank you.
Okay.
Thank you. The next question is from the line of Hiren Ved from Alchemy Capital. Please go ahead.
Hey, hi Neville and team. Thanks for taking my question. Actually, most of my questions are answered. I just have one question, and I know this will be a little difficult because there was inflation and now inflation is coming down. But if you look at a customer, let's say in a larger town, do you see in the basket premiumization happening, which means that let's say if she was buying an X grade of tea, now she's moving up to a higher grade of tea. It may not happen in 1 year, but let's say over 3, 4, 5 years, do you see premiumization in certain categories happening?
So we don't track consumer data at a consumer level, so hence we cannot see that unless we see at an aggregate number. But in general, our view is that modern trade as a format in large towns tends to be the mix tends to be more towards the premium sector than the general trade. Yeah, and I think over a longer period, the contributions tend towards more premiumization in larger towns. They tend to be. Yeah, but these are very marginal movements. Because we don't have consumer data, I cannot answer your question very specifically. But in general, in any category you see, the premium segment is the largest segment. So for example, toilet soaps, when I take all premium segments, their contribution is the highest in the category. When I look at tea, the premium segment contribution is the highest contribution for the category. I look at detergent, washing products, the liquids which are more premium, or the premium powders are the largest contributors. So, by the nature of the format, the affinity of getting in these customers is higher.
Hiren, just stay on the line. I think you just jumped out of the queue. If you can just queue up, we will unmute you again.
Okay.
Thank you.
Michelle, let's just wait for Hiren to just join the queue. I think got jumped out of the queue. We'll just
sure, sir. I'll just check on this, sir. Give me a moment.
Yeah. Okay. 1 minute. He's just joined in. Can you unmute Hiren? He's joined the queue.
Can you hear me?
Yeah, Hiren, we can hear you now.
Okay. No, so I mean, what I'm trying to get at is that if there is a general trend of premiumization, that should benefit you in terms of basket value, though it may be just a few basis points, but overall, over a slightly longer period of time, it should benefit you, right? Because if I'm buying a premium soap or a premium tea or a premium coffee or a premium detergent, right?
Hiren, can you repeat the question? Hello. Yeah.
No, I'm saying that would it be fair to say that the general trend of premiumization in FMCG should also get reflected in your basket values over a period of time?
Yes. Yes. It should.
And are your gross margins in the same category better for a higher premium product versus a lower premium product?
No, we don't look at it like that, Hiren.
Okay.
See, for us is we have our own way metric to look at how much we should earn on each category, and then basis. But there's no discrimination on that. We don't look at it like that at all. our simple funda is जिधर price sensitivity ज़्यादा है उधर we should be more aggressive in our pricing.
Understood. Fair enough. Thanks and all the best.
Thank you.
Bye.
Thank you. The next question is from the line of Tanmay Gupta from Motilal Oswal. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Sir, actually just wanted to understand that, we have opened the largest size store. So how much time does it take to reach the normalized level for those stores level versus, what we have opened at 30,000 square foot stores before? Hello? Hello, am I audible? Hello?
Ladies and gentlemen, the line for the management has got disconnected. Please stay connected while we reconnect the management. Ladies and gentlemen, this is the conference operator. Please note that the line for the management has got disconnected. Please stay connected while we reconnect the management.
Ladies and gentlemen, thank you for patiently holding. The line for the management has been connected. We'll take the next question from the line of Akhil Parekh from Centrum Broking. Please go ahead.
Hi. Thanks for the opportunity. Neville, my first question is, we have highlighted that the external factors which have hurt our sales in general merchandise and apparel. But globally, if I look at it, especially US-based value retailers, they have categorically said that discretionary category for them has also been impacted because of inflation. So do you see that the higher impact on GM&A is because of inflation and not because of competitive intensity going on? That's my first question.
Yes, Akhil, in the previous questions I did mention that when somebody asked about did your customer profile change, and I said no, customer profile has not changed, they remain the same, but they come from a particular background wherein inflation has hurt them the most, and that is why there has been a tightening of the wallet, and hence some impact on the adverse side for general merchandise and apparel. So yes, inflation has affected discretionary for our customers.
Okay. So hopefully, if the inflation impact subsides, we'll see we inching back to the normal level.
I'll not comment on whether we will go back to normal level, but we are seeing that trajectory at least in general merchandise at a significantly better level than apparel. Apparel probably will need a couple of more quarters to have a very clear view.
Sure, got it. Second question is, like you briefly mentioned that there are certain white spaces in the general merchandise and apparel category. So any big white space which we are currently looking at, and which we may add basically in coming times?
Yeah, there are numerous. I wouldn't, not the right forum. You visit our stores time to time, you'll get a sense of what we are doing. I don't want to, comment, because these are all so much of work in progress. I mean, we have certain views now. We may try in a couple of stores, they don't work, so we withdraw, we stop. So I really can't comment on which subcategories. The best way to make a judgment is keep visiting our stores once a quarter at least, and you'll get a sense of what's going on. In fact, that's something which we also keep saying. Like at one end, we keep saying that don't change anything, keep everything the same, everything should be, business as usual, assortment, all of that. But at the same time, there's another part of the side of thinking is there has to be some novelty or some new opportunity should be created all the time to keep the format fresh. And just that the products should be blockbusters. They should be something that solves a particular purpose for the customer. So you need to have this both left and right brain working at the same time. And that's why it's quite challenging at times to get that alignment. You get leadership to understand the nuance of how to operate with keeping both that mindsets at the same time. Yeah.
Sure. And lastly, on the pharmacy part of the business, in past, I remember, I think in FY19, we had, you had answered this question on, probably looking at eyewear as a category, because I think as organized retail is very small in eyewear, and Lenskart as a retailer has done very well in eyewear category. But instead of that, we are looking for pharmacy, which is highly competitive in nature, both from brick and mortar as well as e-commerce part of the business. So any thoughts on that, why we went for pharmacy over say any other category like say eyewear?
Well, it's a natural extension. And for no other reason. And it has a decent size of opportunity. And I don't know why you bring sunglasses, but I'll just quickly, the thought comes to my mind is anything that is high margin and anything that needs extensive detailed servicing is something that is not our core competence.
Okay.
So it's not that we never thought about this eyewear business, but it needs a different mindset to operate, which we believe we don't bring to the table. But pharmacy is very value driven. At certain homes, you need medication for a long period of time, a good value per month. Margins are there to discount, to give great value. So the similarities to the grocery business are there, and it doesn't need that quantum of personalization or service. So I think that's why we believe there is alignment.
Sure. That's all from my side. Thank you so much.
Sure.
Thank you. The next question is from the line of Tanmay Gupta from Motilal Oswal. Please go ahead.
Yeah, am I audible?
Yeah, Tanmay, sorry you got dropped.
Yeah. Sorry. Okay. So actually, sir, the question is, since we have opened the larger size stores and versus the 30,000 square feet in previously, so just wanted to understand that how much time does it take for the larger size store to reach at the normalized level versus the 30,000 square feet stores?
So Tanmay, different stores or different cohorts operate at different levels. There is no normal or there is no midpoint average. Different stores operate at different levels of, while the variability in gross margin may not be large, but there will be a huge variability in operating cost and a huge variability in profit at that store level.
So I'm just asking on a revenue per square feet level, like just to understand that, for example, if 35,000 square feet stores got mature in 3 years, and after that we can see stable SSG going forward. So for a 45,000 square feet store, I believe that the years could be more. I think mature years could be like 4 or 5 years. So is that my sense right in this sense?
Yeah, quite likely, right. So larger the city, smaller the store size, significantly higher the turnover square feet. And then in that order, just put these three elements on a piece of paper, and then you toggle them up or down, and you'll have a differential revenue per square feet up or down.
Correct. And also, second question following up that, since we have added most of the larger size store in the COVID period, like in 3 years, so is it right to believe that most of the stores are in base now, and it should now contribute substantial growth?
We all hope so.
Yeah, because just calculating, so most of the things seems now in the base. So just wanted to confirm in such sense.
See, the point is, again, okay, let me answer this question a little differently. We look at cohorts at every gap of say 3 years. Okay, so we have older stores which are probably now 17 years and older, then 15 years and older, then 13 years and older, things like that. And within that cohort, we look at, okay, how is the SSG growing? Is it growing at a rate higher than inflation? If not, what are the things that we need to do? Okay, and then one of the criteria why these stores don't go well is if the stores are very small or the turnover square feet is very high. Otherwise, these stores should grow. And if they are not growing, then we work on what we need to do to make them grow. Right? So that's it. It's a very micro, region by region kind of an approach, and try and understand, what we need to do to make it better.
Understood, sir. Thanks a lot.
Yeah.
Thank you. The next question is from the line of Swati from Hillfort Capital. Please go ahead.
Hi, Neville. I have yet another question on apparel, which is that it looks like some of these newer, larger stores, they seem to have more space allocated to apparel, at least, from when we visited the stores. So just wanted to understand, does that compound the problem, number one? And I know someone's asked this earlier, but because maybe there is larger space being allocated to it, does it affect our ability to reinvest in the core FMCG business and keep it as attractive? That's the first question.
Not really. I think the way that the organization is structured, different teams run different categories. So because something is not happening right in apparel doesn't impact the FMCG side, number one. Even from a financial allocation, investment allocation, no difference. So that's not the case. We are very cognizant about the first part of your question, which is you give more space, but sales doesn't happen. How does it, from an inventory turn, especially perspective, are we getting impacted? We're very cognizant of that. In fact, you notice that inventories have actually fallen. So that's the beauty about the format, right? Our ability to quickly recalibrate all the elements of that line of business is fantastic. And that needs a lot of effort, mindset, technology, everything has to be aligned, and that's there, I think. So then comes to the point of, okay, if contributions are lower, can we reduce stores? We do that also. We used to do that even in the past. We reduce store sizes. We reduce trading areas. We do that too. But the point is, that's the beauty of the format. That we have all these levers capable, available. People are empowered. In fact, and these calls also are taken at a significantly lower level from me. For me, it's just a FYI. We're doing this because of this reason. So I think that way the organization is pretty agile and empowered to take calls to ensure the overall, operating principle remains intact and the financial discipline is maintained. Yeah.
Yeah, thank you. And the second part is you did mention that there is a lot of work that needs to be done here, and I think you mentioned some of the things that we will not do. Do you mind spelling out some initiatives that we are taking here, if it's related to supply chain, pricing, on the apparel side, I mean?
I think the bigger aspect on apparel is people. I think 70% of the issue is people. I mean, they drive it. I mean, it's apparel is a very person-driven, competence-driven business. I think that's the key part.
All right. And just one small question, last one from me, is that curious to understand if the segment mix in our e-commerce business, is it very similar to the brick and mortar business or not really?
No, everything on the FMCG side is the same. We have very, very little of the general merchandise and apparel. Very little.
Okay, got it. Thank you.
Thank you. The next question is from the line of Devin Kulkarni from Marcellus. Please go ahead.
Yeah, hi, Navin. Can you hear me?
Yes, Devin. Hi.
So, Navin, my first question is on the apparel front. What sort of buying principles or the buying practices have been followed? Also, we have seen a personnel change out there in the last year. What have been the incremental steps that have been taken or new ways of working that have been introduced by the new personnel?
I didn't get your question. Can you repeat the question?
Yeah, so I wanted to understand what sort of a buying practice were we following in apparel. And secondly, we have seen a person from Shoppers has come in to lead the apparel business in the last 1 year. What changes has he brought to the buying process for the apparel division?
Too early to comment, Devin, but since you are mentioning that, and you're already observing that we are doing some stuff. So that's it. So that's what it's all work in progress. We're working on it. And
what are the basic buying principles on which we work?
See, principles remain the same. The broad ethos of what we stand for remain the same. The quality of execution has to get better.
Okay.
And we need apparel experts who understand the customer and figure out what is that white space that we need to be more sharp. How do we make that white space more sharper? Okay, so that we present the product in a manner that is very difficult for anybody in competition to replicate. Very simply put.
Okay, understood. Secondly, on the store opening front, right? You said that 80% internally you are
Excuse
prepared.
me, sir, your audio is not coming clear, sir. May we request you to use your handset if possible, if you're using it?
Sure. 1 second.
Okay, sir.
Is this better?
Yes, sir. Please continue.
Yeah. So on the store opening front, right? You said you are 80% internally prepared to do a 60-store expansion. 20% there seems to be some internal capabilities still to be built out. So in the last 5 years, right, what internal capabilities have you invested in to be able to ramp up your store count? Secondly, what are the bottlenecks today internally in store count opening? External bottlenecks, you explained the market, real estate, all that. But internally, I'm trying to understand where all are the bottlenecks in expanding the capacity of store expansion.
It's primarily around talent. We need high quality talent here. See, there are certain, we all know what's happening in the country. Like there are these certain sectors, like let's look at IT. Within IT, it is IT security and IT security ops. Acute demand supply mismatch. People come with 3 offers, and these offers, it's like one offer is 100% higher than the existing salary, one is 150% higher. And it's crazy, some of these things, right? And right. And it's not even about that. What we also see is that even after offering those kind of crazy hikes, again after 6 months somebody leaves because he's got a further hike from somewhere else. It's ridiculous. Some of these things are it's completely nuts,
Right, and that's at the BD level team, right? At the top level, is there any operational bandwidth constraints between, let's say, you and Mr. Baheti in approving these properties?
He's right next to me. No, not really. In fact, they're pretty fast in that. Pretty fast. It's just that, let me put it this way also. There are certain...
Navin, what would help me if you could just take me through that finalization process and then you can explain why there is no bandwidth constraint.
Come again?
If you could just explain me how the property finalization is done between you and Mr. Baheti, and then in that you can weave in why there is an operational bandwidth or not.
It's exactly similar to how you must have bought a house, right? how do you negotiate with the developer? He will tell you 20,000, you will have in your mind 18,000, and then you come somewhere in between. That doesn't take more time. That's hardly 1% of the problem. The larger problem is scouting for land, bringing the developer or a landowner to a level that suits us. The title has to be clean and clear. There's a lot of handshake is the easiest part. Mr. Baheti and my job is the easiest part in the whole scheme of things. We just catch a flight, go and meet him and finish the deal in 5 minutes. That's the easiest part. That's not the bottleneck. These bottlenecks or these problems are with MNCs who come in other countries to do real estate deals. Okay, corporates or promoters or owners who operate in the country where they belong to, finalization is the least of the problem. It is the due diligence and all the effort prior to that takes a lot of time.
Understood.
Let me give you another analogy. This is probably one of the reasons why, even if you look at the real estate developer landscape, right, you always have each developer having his core focus in his region. And any developer who's tried to do that across the country, we know what happens, right? So this is very typical about this industry.
Understood. And that BD team is seeing a lot of high attrition. That's why it's causing some internal challenges for you.
Yeah, also because this sector, this nature of role or this type of role spec is very new to this country, right?
Right.
If you go back, 20 years, there was nothing like this, right? At this scale that you would want today. So the inherent development of talent in this sector is very minimal. Whatever talent that is developed in this sector is either leasing, which these IPCs do, yeah, or it is extremely large land deals, where the clients they service are large developers. So our need is very, very niche and very unique. So that creates a limitation for us.
Understood. Finally, on the succession planning front, right? What we've seen is since listing, there have been a few 5-7 VP level exits that have happened. Some of these were replaced externally. So firstly, why are these exits happening despite being heavily rewarded through ESOPs? Secondly, why were the replacements brought in externally? What is the challenge in promoting internally? Thirdly, how are we maintaining the company's culture? How are we inducting the new external hires into the company culture?
Yeah. So if you look at, I've done a little bit of research on this. When a company moves from 100 crore revenue to a 40,000 crore revenue over 20 years, the ability to retain our talent to the extent we have done, I think we will be in the minority. We have retained significantly higher number of old talent than most other industries, or most other companies who've gone through this route. Number one, yeah, and I'm happy to be corrected, but this is my point of view. Number one. Number two, which I also mentioned in our BRSR, the challenge we also have is the nature of this industry. Why, whenever we hire people from outside, why they don't last too long is the nature of the job here is very, very different. It's very tactical, very operational. It has a huge amount of operational rigor, physical effort, traveling, meeting blue-collared workers, all of that. And generally top-level leadership wouldn't want to have a role like this. Okay, and that has been our interpretation. Guys are great, but probably, and that's again a challenge because this industry is relatively new from that standpoint. And our need is also like that. We want people to be deeply connected to the ground. Yeah, so that could also be another challenge. Third is about promoting people internally. Again, I'll bet on this. The quality and the effort that we put in terms of promoting people from within is phenomenal. We take great pride in doing that. Yeah. So even there, I would love to do a ref check, or I would like you. I've mentioned this even in the previous analyst meet. I would like you to go and see our stores, okay, and talk to our supervisors, talk to our managers, and ask them how many.
Yeah, no, I agree. Your internal promotion till the buyer level or till the general manager level is superb. the layer where the AVP, VP layer is where we are seeing some attrition, and that's where I wanted to raise, like, are these GM level guys not capable enough to elevate to the VP, or what's the gap out there?
So again, it's not a binary. A lot of spaces people internally have taken those top jobs, right? That is N-1 or N-2. In fact, N-1, N-2, most of them are been with the firm for a very, very long time. Yeah.
Right.
But at the same time, company is also growing at this even at this rate at 18%, 20%. 2 years back, it's growing at 30% or 25%, right? When you're adding $1 billion of revenue, you also need a lot of people from outside, right? You can't fulfill every position or everything internally, right? And in a way, it is good. It's good to bring a small percentage of people from outside because they bring that outside the outside perspective, right, about things, which helps the organization.
Okay.
So, yeah.
And finally, how are we inculcating these external hires into the DMart culture?
What do you want me to say?
No, like, how do they, let's say, what is the induction process for these guys to get that DMart culture? Because it's useless if you bring in someone and then he just leaves after 1 year, given, he can't fit in. So how are you making them fit into the DMart way of working or the DMart mindset?
See, it doesn't start after he joins. I personally do this, especially with senior leadership, at least N-2 or N-3. I personally have a chat and explain. So while everybody will sell their company, we actually warn them or alert them about what this job involves. Okay, so that they know what they're getting into. So that is, it starts before you hire somebody. You have to have this very candid conversation. Look, this is the role. This is what is expected out of you. All of that. Okay. At the same time, whenever somebody joins, we are not very number centric. Even with top leadership, for the first 1 year, there is no deliverables at all. It may sound crazy in today's world, but I personally ensure that it's not there. He should first understand, and a deep-rooted, culture-oriented, value retail kind of a format needs to understand the nuance of what this company is all about and how this business has to be run. So all those typical trappings of any other firm where, I have a KRA, I have a target, I have to deliver a profit margin target, I have to deliver a store addition target. We don't do that for the first 1 year. We first ensure that he kind of soaks into the culture, the way we operate and all of that, right? And I think when you say culture, it's not very complicated. We are a very, very simple, straightforward, matter-of-fact company. Yeah. So we... that's it. I mean, it's so sometimes some people also get unnerved by that kind of an approach, right? We minimize meetings. We want action. We want things to get done. We don't want people to ideate too much. It's a very straightforward business, and even that kind of gets unsettling. Imagine somebody who's worked in an MNC, FMCG company where ideation is the key factor of getting outcomes, right? Which we also see when they operate. So we try to tone that down and focus more on getting things done, more execution, more action orientation. Huge amount of people connect. Yeah.
Understood. All right, fine. That's good for me.
Yeah.
Thank you. The next question is from the line of Mandar Pawar from Kotak Mahindra AMC. Please go ahead.
Yeah. Hi. Good afternoon, Neville and team. Thank you for giving this opportunity. Just wanted to understand, when we are looking at the modern trade and the number of players, be it online, offline, quick commerce numbers increasing and attaining size, has it in any way put our distributor margins or the sourcing margins at any kind of pressure?
So you're saying that our margins going down because of this?
Yeah. Yeah, I'm trying to check whether is there any case like that or we have been able to hold up our margins.
Yeah, there's no issue there.
Okay. All right.
I'll give you one snippet on this. D2C guys, some companies, I don't want to name them, but they haven't been coming for a very long time, and then when they come to us, and then we deliver, we become their largest customer. Okay, so we also have situations like that. So we are still a very important channel for a lot of brands. In fact, we say no to a lot of brands because we think that the quality is not good enough, so we don't launch them. But wherever we find good quality at good price, we launch them, we actually become the largest supplier for them.
Got it. Sure. Second, just coming back to the topic of apparels as a category. Now, if I look at the sales and the ratio that you are giving, and if I assume a constant ratio for the space that you allocate to general merchandise and apparels, the math works out like we are on a per square feet basis we are still 20% lower as compared to the pre-COVID levels. Now, of course, there will be inflation in the raw material, which also would have got passed also, which means the volume decline would be higher than that 20% in terms of value. Whether it is also a function of a very significantly lesser space being allocated to GMA as because the traction is weaker.
I just tell me the last sentence, last point, I couldn't get it.
Yeah. So if I assume that the ratio of space allocated to GMA is constant, then it indicates a decline in the revenue per square feet. So either that premise is wrong, where that ratio is constant, and effectively you have given lesser space allocated to GMA category. Is that something which has happened, where because the traction in this category is weaker, you have decided to allocate a lesser space to that and more towards the other categories?
No, space has not yet reduced all across. No. Space for GMA has not been reduced, if that's what you're asking.
Yes. Okay. Okay, that has not.
Selective one-off calls where it's really small and is impacting the inventory turns, but otherwise, no.
All right. Just one final question on when I look at the your cluster-based approach and the way we have spread our presence across the states. Two notable differences are the states of Goa and Kerala. Just wanted to understand whether there are any specific challenges that you face in those states, or something that is not fitting completely with the philosophy that we have in terms of our operating and profitability metrics.
So some states we haven't gone yet. Okay, and generally both these states you mentioned, there's a lot of land restriction, by the way, because they are ecologically sensitive regions. So very little land is available for commercial activity, and those prices are extremely high. But hopefully we'll have a store in one of these states soon.
Got it. All right. Okay. Thank you, team. Thanks for the opportunity.
Thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Good afternoon, Neville and team. A couple of questions from my side. Neville, in our observation, the limited success that we have seen in GMA retail space in the country has come from very sharp focus on private labels. So first question, do you agree to the observation? And second, if yes, then how do you see private label journey in GMA space? Because we have been very, very calibrated on private label commitment on the grocery side.
But what is your understanding in GMA? Do you think we have private labels, or you think we are not private labels?
No, it is there, but in grocery you have been very, very clear that it is like it will be a trial and error. And on this side, it is kind of when you scale up, because you mentioned on the last call that there are multiple dimensions to private label, that there's a higher commitment to inventory, and we should not look at from a lens of only margin. So just wanted to understand that when you scale up GMA and when we go on that journey, how do you see that private label commitment shaping up?
So GMA, as I've commented, so बोलने के लिए है that it's not private label, but in a way it is kind of a private label. They are manufacturer brands. Okay, just that, and they are not very popular per se by the name. Just that because it has the manufacturer's brand, he's significantly more invested than say an FMCG private label brand. Okay, so from that standpoint, I don't know what you're asking, but whatever we are doing, we will do it exactly within the same format and structure that we are currently operating. They are all manufacturer brands.
No, the question was largely on Costco Kinker model also, the way they have popularized their GMA brands. Will we invest in the branding side as well or not in terms of popularizing the brand also on branding investment?
Okay. Our view there is in the GMA is quite chaotic. In the price point that we operate, branding as such is not, and it will evolve over a period of time. Like for example, we are doing, let's say in apparel, we are doing branding now on the socks, the handkerchiefs. So wherever there is very clear, sharp segmentation, branding adds value. Wherever there is chaos and everything goes all across the place, having a brand may not be the best way to approach it. You have to give it more time.
And just one academic question. By design, e-commerce kind of business throws a lot of data with a lot of vanity metrics also, DAO, MAU, GMV, and we are usually known to keep things simple. So was just curious, which are the top 3 or 4 KPIs you monitor to kind of assess the efficiency of that part of the business?
Yeah, they're just standard, all commonsensical. So we have one on time in full. So on time means if customer has ordered at a particular time and date slot, you ensure what percentage of the orders reach at that time. Then in full, so OTIF, we call it OTIF. In full means you order 20 items, all 20 should go. Yeah, at line and at depth level, whatever, So things like that. So this is at the customer level because that's the final proof of the pudding, right? But then to deliver that, what do we need to do at the back end? All orders for the next 2 or 3 days, we already know right now. So you have to ensure that you are planning of manpower. So there are metrics around that. Then you have metrics around pickers. You have metrics around vehicles. So the usual stuff. So one is the output metric, and then you look at the input metric that will drive that output metric to be delivered 100%. Yeah. So, and the beautiful thing about all of this is everything is measurable, everything is digitized, everything can be tracked. There's no paper, and there is no reporting post-mortem. It's all real time. So if we know that suddenly it's rained and today, right now, and everything is getting flooded, we know that delivery will be affected for the future orders. We inform the customers in advance, and we recalibrate the delivery schedule, stuff like that. So that's how we operate the business.
And lastly, on store expansion.
I just want to clarify simplicity. Simplicity doesn't mean that you ignore data, you don't have metrics to evaluate. We have a very sophisticated way of looking at data. Yeah. To ensure that we deliver, but we don't get into unnecessary, metrics to.
Yeah, that's what I meant. We try to reduce noise on some of these parameters. Yeah, and last thing, whenever we speak about store expansion, you actually speak in terms of absolute stores usually. So do we internally think in terms of percentage space addition and then hence capability building also should be seen as we go on a higher base, the capacity or capability both can be seen from percentage terms?
Yeah, internally everything is percentage. We look at it percentage, but it's not percentage of square footage addition. That's a dangerous line of thinking to go into. If you go there, you're finished. Okay, percentage is percentage number of stores. It's very clear. If I add 20% more stores CAGR every year, and that's what I personally tell my team. If I'm 500 stores, 20% of 500 is 100. We should be opening 100 stores every year. If I'm 1,000 stores, 20% of 1,000 stores is 200 stores every year. Very clear. And then the math beautifully works. That you'll get around 15% CAGR from new stores, and you'll get around 7 to 8%, or probably even a higher CAGR, because then you have consistently a young cohort of stores in your system all the time. And that is the story of DMart, say, except for the last 2 years. Yeah. So you need that for sure, but giving a number is better because it's more precise, right? For you guys.
just curious, Neville, can you elaborate on that point, that that's a dangerous line of thinking? Because most of our engagement with other retailers is hardly on this point.
Because our entire model is based on profitability at store level, no? So if profitability at store level is an objective, then if I need only 30,000 square feet, I'll not have a 1 lakh square feet store, no? Because of vanity.
Very clear, very clear. Thanks a lot and all.
Yeah, thanks.
Thank you. Thank you, members of the management. Ladies and gentlemen, with that, we conclude today's conference call. On behalf of Avenue Supermarts Limited, we thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you, Michelle.
Thank you, Michelle.
Thank you, sir.